Hello, everybody. Kirk Spano back from Las Vegas and not hungover. I actually got my life insurance exam results this morning, and they agree I'm fairly healthy for a chubby guy. So I'm going to get rid of that chub here the rest of the year and see if I can get even healthier. But yeah, all my numbers were pretty good. I was very happy with that. Yeah, I'm a little more healthy than the average 53-year-old, so that's great. All right, so we're most of the way through earnings season, and a couple of things that I would point out, we talked about last week, is that the beats for the companies that are reporting are in line with the past, but not as big. So as many companies are beating, but by narrower amounts than in the past. Now, the fourth quarter earnings, as we talked about, appear to have been negative for the first time since 2020. So if 4.9% ends up actually being the decline in year-over-year earnings for Q4, that's pretty substantial. The earnings revisions that we're seeing right now are overwhelmingly negative. So that can't be good. We got 58 companies that have issued negative guidance. Only 13 have issued positive guidance. Those seem to get the press. The PE ratio is still elevated at 18, which is historically high. It's high against the 10-year average. It's a little below the 5-year average, but of course, that included 2021. So PE ratio probably indicates a 5 to 10% correction on the stock market from here. But as we know, in the short term, the stock market is a popularity contest, not a weighing machine. So when it comes to earnings, we really want to look out 2, 3, 4, 5 years and try to figure out what those curves look like. And I will maintain that the curves are going to look a lot better for technology than almost anything else. And here's why. Okay, the big technology companies are the ones with the money, and the small technology companies are the ones with the growth. It's pretty much that simple. Now, you can throw in clean energy right into your technology basket because it's all tech-driven. The fourth industrial revolution, with all the new types of technology, apply to every sector out there, every industry out there, and that's where you find your winners. Either the tech creators, the ones that collect recurring revenues from their technology, or the industrial companies and other companies, commercial companies that use the technology better than their peers. And that's where you're going to find your winners. I will tell you something about Las Vegas as we get into taking a look at some of the things from Tom Lee. Remember last summer, I told you that I had never seen Las Vegas that busy in over 30 years. So since I've been going in the mid-90s, I had never seen Las Vegas as busy as it was last June. I'll tell you, this trip here in February, which is not usually a super hot period, but it's not supposed to be this slow. Las Vegas was crazy slow this week until Friday. And even on Friday, it wasn't hopping except at a couple of casinos. And we went to a bunch of casinos on Friday. We went to Caesars, Harrah's, The Link, Flamingo, Horseshoe, which was Bally's, and Paris. So those are all kind of where we were. But we also, because we went to the Mirage for a show on Thursday, decided to head out. And I can't remember where we went to eat that we ended up at the Venetian. Oh, we went and visited friends out at the Suncoast, which was dead. And then we came down to the Venetian because we wanted a cannoli at midnight. And we couldn't get a cannoli at the Venetian at midnight. How much sense does that make? They have a whole mall. But the mall was pretty much shut down. There was almost nobody in there. There was a couple of little restaurants. The gelato was open, but you could not get a cannoli at the Venetian. Although we did get to see Penn and Teller playing a slot machine together with a friend. So that was interesting. Almost walked up to him, but I hate bugging celebrities in public when they're trying to chill out. Any case, Vegas was slow. Why do I bring that up? It just wasn't the big crowd spending money that you would think as people try to escape winter. So keep that in mind. I think that what we saw here from FactSet with a lot of companies guiding lower, I think that holds in a lot of places. And I point out the casino industry because that's the ultimate consumer, right? I think that you are going to see some ebb and flow here from the consumer over the next year or so. And a lot of it depends on where energy goes. If the price of energy rises and the price of gasoline rises, you're going to see a lot of people sitting on their wallets. As I've told you, I think that is my biggest concern, is that between Russia, OPEC, and the China reopening, energy prices go up again. And that drives inflation in the short term. So let's take a look at what Thomas Lee is saying. Tom Lee is saying that it looks like we're going to be in a bull market for this year. I am still on a coin flip with that. I lean bearish, you know that. I don't think the bear market is over, mainly because him and I disagree on what direction energy and housing are likely to go. So Tom Lee believes that energy is going to be choppy and stable, and that housing is going to crash. I believe the energy prices are going to go up and that housing is going to be choppy to stable. Why do I believe those two things? Well, you already know that I believe China, Russia, and OPEC have it out for the United States, and in particular Joe Biden, because they don't like the Democrats, because they don't get what they want from the Democrats. You know, Joe Biden's out there shooting down stuff in the sky and taking away technology from China. And now we hear that we're probably going to put some pretty strong constraints on American money flowing into Chinese investments. That's a concern to me. You know, we're way up on our emerging markets bet, which includes 50% China, and we have to really think that through. Is it time to take profits if the dollar is going to get stronger on higher energy prices? You know, all those things play together. If energy prices go up, Fed's not going to back off. That means the dollar goes higher, which means that foreign investments go lower. Pretty simple. So I am not feeling highly confident in the emerging markets trade right now, because I am fairly certain that my macro analysis of what China, Russia, and OPEC are going to do to energy prices is very likely to be correct. Now, does that mean it's for sure going to be correct? No. If I'm wrong, and if energy prices stay lower rather than jumping back up, then that means the Tom Lee's probably right, and the stock market continues to go up. You know, pick your horse. I think it makes sense for everybody to be a little bit cautious. There's about $4 trillion in money markets right now. Normal is $3 trillion. So there's $1 trillion laying around that could get invested at some point. Now, there is a small sample size that says when January is up, the whole year will be up. Here's the problem. Over 70 years, 80 years, however long this goes back, it's such a small sample size that can you really say that it matters? You know, from a statistical analysis standpoint, having 80 data points is not really going to tell you very much. So all the quant data that's based on relatively few data points, and we've talked about this before, if you don't have a lot of data points, it doesn't matter. So for example, if you flip a coin 10 times and it comes up heads 6 times, does that mean that you're 60% likely to get heads? Pretty easy way to think about it, isn't it? So when the data sets are small, they're not very reliable. Keep that in mind. Now, do I think that we're going to get a 20% up here? No, I've said that I thought, and my prediction was that we'd have a very minimal up here after we retest the bottom, maybe set a new bottom, but there needs to be a retest of October possibly, but June for sure. So if we retest June, then we have some things to worry about. So Tom Lee is saying that October was the bottom, that this is a new uptrend. It could be, but what Shooter is seeing is a little bit different, and I'll show you that in a minute. So Tom Lee thinks that these are false inflation fears, and he says, does anyone think that used cars are going to go to the moon again? No, but they're not really going to fall in price anymore. They fell back in January, which is normal. But if you really understand the dynamics of the car market, it's that there were no leased cars in 2020 or 2021. So that means that the inventory of used cars is going to remain pretty weak until 2025. So you're not going to see a lot of used cars to create the supply to fill the demand. And every car dealership is still feeling that. There just aren't a lot of used cars out there to buy. It comes from there not having been a lot of new cars bought in 2020 and 2021. So if the leases and new car purchases picked up in 2022, which they did, that means it's 2024 before that first batch of leased cars hits. But remember, most leases are 3 years, not 2 years. So it's really going to take until 2025 before you see the used car market starting to pick up. And that heads right into which year? The pivot in production to EVs by Ford and GM and Chrysler. So all these things are playing a role. I think we're going to have firm car prices this year and probably next year before car prices really start to fall, probably the end of 2024, but into 2025. Now, if we take a look at the gasoline, he's saying the gasoline is not going to really go up. I see that as wrong because of China, Russia, and OPEC. He thinks that housing is going to tank later in 2023. Well, I tell you what, I look at a half a dozen real estate markets very regularly. And if you go to realtor.com or Zillow, whichever one you want to use, they're extremely similar, 99% similar. What you're going to find is that the supply of housing is still low. So even though you're seeing some minor price corrections, right, $400 lower, from $344.9 to $344.5. The guy got what he's asking because he's got a pending offer. So as I've been going through this, the houses that I'm interested in, 4 bedrooms, 3 baths, quarter acre, they're just not moving down very much. I mean, literally in the hundreds or a couple $1,000. I've been doing searches in Florida, and that's extremely firm. Been doing searches in Manhattan. I took a quick look at Detroit. You look at the Milwaukee market, the Brookfield market near us. That's a western suburb. You're just not seeing real estate fall off very much. And I'm sad about that because I want to be a buyer. But there's not a lot of people out there like me who are going to be able to just go scoop up $500,000 or $600,000 house if they want to. I'm thinking of buying my retirement home now. It's kind of what I'm thinking, or at least my half-time home. I mean, I have a unique set of circumstances that tell me Las Vegas makes sense. Although I will tell you, if I could stand bugs as big as a pillow, I'd probably take a look at parts of Florida that don't flood. Not a lot of those, but they're there. And unfortunately, the parts of Florida that don't flood are very expensive. So is Tom Lee right about housing gonna tank? I don't think so. And by the way, Tom Lee is not that cool. So whoever wrote this is not Tom Lee. He is about as tight-laced as you get. And I don't think, even though he purports this to be macro research, it's really quantitative research and technical research, and then he wrap it into a narrative. And he wasn't very good last year. So far, he's ahead this year. But of course, we bought in October, November as well, because Shooter said to. If housing doesn't tank, inflation is still going to be there because owner equivalent rent is now a bigger part of the CPI. Used cars, they reduce. So if used cars stay firm, it just doesn't matter very much. But if housing doesn't come down, it's kind of a big deal because now it's a bigger part of the formula. Energy services also became a bigger part of the formula. Not much, 0.4%, but the cost to do oil production is expensive and getting more expensive because just so many of those boomers who are working in the industry are never coming back. Energy goods, they reduce that a little bit. So if the oil and gas does get more expensive, it has a little bit less impact, right? So you can see most of these didn't change much. The ones that changed a lot were rents, used cars. Somebody says that selling a house means giving up cheap mortgages. Right. And that's an important point. People who have a 3% or 4% mortgage, unless they really have the cash to move or a job opportunity, they're not moving. They can't afford to sell the house that they have at 3 or 4% and move to another house at 6 or 7%. Most people should have never bought as much house as they did in the first place. I mean, that's almost universal. People almost always overbuy their home. There are not a lot of people like me living in a condo that's, a quarter of what we can afford. Most people buy as much as they can afford that day without thinking about what if we take a pay decrease. So they're not going to move. That means supply will stay tight. So, there will be more homes entering the market later this decade, but there might also be more people. And then you have the baby boomers who will start to die and downsize and die. I don't think that housing is going to tank. I think new housing might slow down, which again hurts the supply issues. So here's what I think about inflation tomorrow. I think based on all the numbers that we've seen so far, all the leading indicators on inflation, right? All those components that are reporting, there are about a third of them that are seeing falling prices. That means the other 2/3 aren't. CNBC been getting a little bit better lately. They're talking about different supply chain issues that could affect inflation going forward. I think that we're going to get a small resurgence in inflation, and that will be enough to keep the Fed pretty firm until later this year. I keep targeting around Labor Day. It keeps coming up as makes a lot of sense. But again, if OPEC really pushes oil prices up and gas prices up, I mean, that's a wild card. And I think it's more likely than not that they do push oil and gas prices up. Plus, Israel and Iran. I think the odds of a oil shock, not a horrible oil shock, but enough of an oil shock to push a barrel of oil back up towards 100 is pretty likely. I never bought into the $300 barrel of oil. I still don't. Demand is basically non-existent, right? Demand growth is non-existent in oil, except for the little ups and downs when a major economy reopens from COVID, which is going on again, right? United States and Europe, and now China's happening. 2-year treasury, 10-year treasury, biggest inversion, I don't know, very, very long time, maybe ever. Mexico is showing inflation. That's a harbinger. Bowman was not a super hawk. He's kind of a moderate, expects more rate hikes to reach inflation. So right now the messaging is coming out, more rate hikes. In line with this guy who says higher rates for longer and continuing QT could pressure stocks until it doesn't, right? It's not going to be as gradual as people want to make it out to be. Main Street is concerned, Wall Street, right? They're having a FOMO rally right now. Can it last a long time? Sure. We saw it happen in 2021. Maybe it happens again in 2023. I point to the energy as a reason why it wouldn't. MarketWatch, Morningstar, showing that there'd be another bump in the road towards lower inflation. Ultimately, energy prices have to hold a lower range for inflation to settle down. And again, I tell you, I don't see that happening until middle of the decade, 25, 26. Keep an eye on the headlines for when the panic pumping starts. Get this headline out all of a sudden, right? People trying to say that oil demand fears are going to get the Fed to pause. That just doesn't make any sense. If there's a lull in oil demand growth in the short term, right, from the no rebound in China, then we'll see. The reality is there hasn't really been oil demand growth for years, like 1% a year. So it's just the waviness, right, the sine wave that you see that creates whatever push or pull there is going to be in the short term. In the short term, China reopening will push oil demand up. But in the long term, the shift to EVs and hydrogen for heavy industry and energy storage and transportation is going to push it down. And by the way, are we on the brink of a corporate credit crisis? I think this article is way early. What did I tell you in 2020? Most of the loans, most of the debt at the corporate level is pushed out to 2025 and 6. That's when we have to worry about corporate debt really hitting some hard walls, 25 and 26 in particular. So will falling energy prices offset some of that pain? We'll see. But there's a lot of S&P 500 stocks, they have a lot of debt. And while the technology companies are getting beat up, I think that represents a huge opportunity because, by the way, technology is where you have most of the cash generation and most of the growth. The top 30 stocks, I believe it is, and we'll say, I usually say 50 to give myself wiggle room. The top 50 stocks on the QQQ have over 70% of all the cash on American corporate balance sheets. Somebody asked Jim Cramer about Procter & Gamble on Friday. I was on siesta in the middle of the afternoon between here and there in Vegas. I turned on Jim Cramer, and he said that we're absolutely in a bull market, that Procter & Gamble is one of the best places to be. Now, if you're a student of the market, then you know that if we're in a bull market, a consumer defensive stock is not the best place to be. I kind of want you to go back and watch the Friday show, Cramer's Friday show. He says so many stupid things in succession that I started to laugh. Just off the charts stupidity coming out of his mouth. And he's contradicting himself every other sentence, but because the people who watch that show don't know any better, they don't know any better. So, in any case, S&P 500, where are we now? So this is the new bull market that Tom Lee is pointing to. This green line is pretty heavy resistance. To really be a bull market, it needs to break out past about 425, 426. Could it? Well, weirdly, even Avi Gilbert and I agree that this is the point that is going to test everything. If it doesn't blow through 426 on the way to testing the highs, then it's going to head back down. And I asked Shooter this morning, what would a 5-wave down look like? Because as a part of this bigger picture, this is the trend line to look at. Low, lower low. Could there be a lower low? This area here, pretty good support. So if it breaks through this line, pretty much going to the red line. If it breaks through the red line, that's bad. And probably going to the orange line. This is where the money flows indicate. This is where the technical indicators indicate. And I will maintain that the linchpin here, again, is do energy prices go higher? They've fallen back a bit. Can we count on that into a period when clearly, Russia, OPEC, and China would rather see a right winger in our government, in the presidency? They're going to try to manipulate things again. If you don't believe that, you haven't been paying attention since the 1970s. So I still like buying a couple of our oil stocks on the dips, a couple of our energy stocks on the dips, small cap Ametis, New Fortress Energy in particular, I'm going to try to get a piece of. I tried to trade it a little bit. So far, I'm even. I would love to see New Fortress Energy come down to the middle 30s, and then we'll see what happens. Accidental Permian Resources. This is the short-term target. Shooter actually thinks it pretty much probably topping out right now. We're going to head down to 400. And if that indicates a new trend, then we'll get all the way down here to around 300 on the SPY later this year. He's a little later than Labor Day, but this would actually be pretty historically correct. Although, like we said, not many data sets. So Shooter and I both worry about this area where I have mine at 286. What does he have his at? 286. It's pretty funny. We don't work together on our charting. So for us to end up in the same place means that from two different viewpoints, two different techniques, I'm much more volume weighted. He's much more pattern weighted. If the catalyst is energy and energy prices go up, and the Fed has to fight that, then continued quantitative tightening and rates a little higher for longer are going to put pressure on stocks. Now, in my firm, until I have the hedge fund open, I'm a long-only investor. So I don't buy puts and calls, and I never use margin to go short. That is just an agreement that, basically everybody in the state of Wisconsin has to make with the regulators. If you want to short the market or bet against things or buy options, they want you to open a hedge fund. So that's what I'm doing. Now, in my account, I can do what I want. And in my account, I'm looking for puts on the S&P 500 to buy. So this is March, and you can see that I've highlighted some of the places where there's big open interest and big action today. So take a look here. I think somebody bought these puts. They bought these puts. They probably sold these puts. Tomorrow we'll see if this number is up around 101,000. If you have level 2, you can check right now. I don't have mine on. So that would mean that somebody's betting on the S&P 500 to go down and that they're willing to buy it down here, which, if you take a look at my chart, I think is a little bit aggressive. That's about where this right here. They're basically saying that it's going to retest that and not go through. And that could be true. There's a jitterbug zone here and it held there. So if we're in a new bull market, then 380s probably holds. I hope we're in a new bull market. That makes life easier for everybody. Stock market's not usually easy, is it? So I don't really like the March puts. I don't think there's enough time value. I think it requires too much management. So if you look out to June, and again, you'll use March if you're a trader speculator, right? And you're fast moving and you're quick and you're on top of it every day. But if you just want to hedge your portfolio a little bit, I think what you're going to do is buy some puts to June, give you some time value. You have some open interest here, a little bit of open interest here, a little bit of open interest here, then more here. So every $5, you're seeing open interest. Then look at that. So this is actually somebody who's pretty serious. So 360, 365, 370, 375. Somebody is systematically putting into place trades. This looks very algo driven to me. Every $5. And they'll just snowball that. So as they become profitable, they'll take profits and they'll either roll into the next one lower or they'll keep the money in their pocket. So this is a way for them to systematically scale out if things start going their way, or they can pyramid it up by taking the profits and rolling it into further out positions. So I'm going to take a look at these. I don't want to pay this much. I don't really care about moves that are less than 20%. So 20% of 400, I should be looking at about 330 or 340 puts. Big open interest there. Yeah, so this is pretty interesting to me, that big open interest there. So I'll probably look at the 345s. Why? Because I don't lose much if it doesn't drop. But if we do get a big drop, then these will go up 3, 4, 5, 6, 7, 10-fold, especially if we head down to 300, right? If the SPY drops around 300 this summer, then this is going to be around 45, right? Strike price minus premium should equal the actual price minus time value. So I like this 345. The 350 is interesting. You could even do 2, which is probably what I'll do. I think I'm going to do this one. I'm not going to bother with that. Probably do 345 and 380. They're far enough apart. They have big open interest. Buy probably 5 times more of the 345 than I do the 380. And if you wanted to, you could turn around and sell like 310s, even 320s, I guess, as this price rises. So next time, the next oversold, we're currently overbought. This is a weekly RSI. Switch it to daily, right? Will it come up or did it already start coming down? I really think I'm going to make these trades this afternoon. I got to think about it for a couple minutes, but I want to watch to see what starts to happen in a little while. So I'll put these out there for those of you who are interested. And I put these in the chat room. So you need to be in the chat to see this. I'll put it up when I do it. All right. Any questions? Somebody says prices in Charlotte are not dropping. Yeah. Somebody says that Kramer is wrong about the Eagles. I'll tell you what, Patrick Mahomes healthy is a hell of a player. And they got a break at the end, which probably didn't change the outcome because they were going to get the field goal anyway. But I don't know. The NFL is starting to look like the WWE to me. I go all the way back to Eddie DeBartolo betting on sports. I don't know. I wonder how controlled, directed. I don't know the right word. I don't want to say rigged, but I think there's advantages given to certain teams, whether that's just out of normal human psychology and frailties, or if the NFL is pushing an agenda. I don't know. But that was a weak call at the end of the game. The Eagles kind of got in trouble for that. They should have had around 2 minutes to score. Who knows if they would have, right? Who knows? All right. Nobody came up with a question while I mumbled. I carried on. No? Okay. So as you manage your asset allocation, you can try to chase it up, realize that we're getting close to some barriers. And for this to break out higher, I think you need to see those inflation numbers be pretty low tomorrow. And I think they're going to be neutral to a little high just because of December leading into January. Do think in a month they'll be lower, but that's if energy prices don't rise between now and then. I really do think you should be very wary of energy going higher again, which is why you should have that energy basket. Kinder Morgan, New Fortress, Ametis, Occidental, Permian Resources. Those are all companies that benefit from higher gas and oil prices, but every single one of them is also what? Backdoor play on either hydrogen or carbon capture. So every energy company I have that's fossil fuel based also is investing in carbon capture and hydrogen, or hydrogen, in one case both. That's what you have to be looking at if you're going to invest in oil and gas stocks, is do they have a plan in place to get to the next type of energy market that's really going to be moving fast by the end of the decade. All right. I will get this posted, and keep an eye out for a couple articles in the next day. I have to get caught up, and I will. All right. Take care.